today's topic is allowing for inflation and taxation. See, in discounted cash flow, when you invest in a long term investment, definitely you expect the prices to get inflated. Okay, and this happens, it is inevitable. That means it is naturally seen that in long term, since the demand for everything is rising and in future we expect the prices to go up, so whatever the project you are investing into, you expect things to become more costlier and you want inflation factor to include into your cash flows. That means if the raw material is of 5 rupees today, the raw material will become 7 rupees after 2 years. So here if your profit is 10 rupees, here your profit has to be how much? At least 12 rupees. Because of inflation, you want that inflation to to absorb, you want that inflation even, okay, to include in your profits. That means you want that additional cost whatever you are incurring because of inflation in your raw material, you want them to recoup in your profits. I mean to say, because the things are costlier for you, you want to charge extra to your customers because you even are charged extra, okay, by your suppliers for raw material. So that's the reason why inflation is an important factor to be considered in long term investments. So there are two rates: nominal rate, real rate. Nominal rate is something which includes or incorporates inflation in it, and real rate is nothing but it does not incorporate inflation in it. Okay, now suppose your if I want, I can explain you this formula, but before explaining this formula I want to make the concept easier for you. Suppose if I take nominal rate as, suppose the inflation is 2% in the market and the real rate is 5%. Real rate is nothing but in reality what the rate is going on right now. Okay, that is without considering this additional factor called inflation. If inflation was not there, what would have been your rate of return, or what would have been the rate in the market for any of the investments? 5%. Now nominal rate is nothing but real rate plus inflation. Okay, without inflation the rate is 5%. With inflation the rate is 5 plus 2, 7%, and that is nothing but your nominal rate. Okay, that's one. So nominal rate minus inflation is real rate. Nominal rate minus inflation is real rate, and real rate plus inflation is nominal rate. That is what 5 plus 2 is 7. So anything is all right. Okay, so if you add inflation to real rate you get nominal rate. If you subtract inflation from nominal rate you get real rate. That means nominal rate includes inflation even in it. So if I see this equation, I is your nominal rate. So 1 plus I, the nominal rate is equivalent to real rate into inflation. So nominal rate is equal to real rate into the inflation. Okay, that is what they are saying here. That means if your real rate is multiplied with the inflation factor, it becomes the nominal rate. Okay, so if I have to say nominal rate by inflation is real rate, if you discount nominal rate with inflation you get real rate. If you multiply or compound real rate with nominal rate with inflation you get nominal rate. Okay, so here we are compounding inflation with this, we are getting nominal rate. Here we are discounting inflation with this, we are getting real rate. So anything to understand the concept easily, I have given this. Now Let's take this. These are the actual cash flows, and the company's minimum rate of return is 20%. Under present conditions, inflation is running at 10%. Okay. So if anyone asks you what is the, so if at all this is your investment, you will get a return of 200, and it will be 1200. Your investments will grow by 200, so total investment value is 1200 now. Okay. Now this 1200, if I discount with this 10% inflation, that means I remove this inflation. You get this. Okay. So actually the value is 1091. Because of inflation, it has become 1200. Okay. So now 20% is the nominal rate. So with nominal rate, your investment is this. 10% is your inflation. So that is inflation, and this is your real rate. So real rate into inflation is nominal rate. Now you can find out your real rate. So real rate is equal to nominal rate by inflation. So this is inflation. This is a nominal rate. This is the nominal rate by this inflation gives you the real rate 9.1%. Okay. So now this 1200, which is the investment's value because of the inflation, because of high inflation, this I discount with this 1.10 inflation. I remove the inflation from this, it will become 1091. Okay. So that is what here we proved. So another question comes to your mind is, do we use nominal rate or real rate? If cash flows are expressed in terms of actual number of dollars that will be received or paid on various future dates, we use nominal rate. That means in future, for a longer period of time, you're expecting the money to receive, you use nominal rate, because inflation is of course considered. If the cash flows are expressed in terms of value of dollar at time zero, today, if I speak about the cash flow today, we use real rate. So the current rate is real rate, the future rate is always nominal rate. So now here is the question. These are your cash flows. Your discount factor is at the rate of 20%. You get this much as your present value. Okay, that is your NPV. This is you have done at nominal rate. You have found out the NPV at nominal rate. Now, let us do the same thing. First, we will remove the inflation. Okay. So we are just removing the inflation from all these cash flows by discounting with the inflation factor. We got this cash flows. Now whatever the cash flows we got, we are again discounting with the real rate of return. So we got this NPV. So now you see this NPV and this NPV, there is not of much change. Okay, they are almost the same. That means if you discount directly with nominal rate, you are getting this NPV. If you remove the inflation, discount with inflation, and again discount with real rate, you get the same cash flows. That means what they are saying is, in future nominal rate is what has to be expected. That means you should discount at nominal rate. That's it. See, most of the government bonds or government securities, if you purchase, they provide you real rate of return. Okay, they won't consider inflation and all these factors. But for long-term investment, nominal rate of return is always expected. Now, this is a question. Will you do this as a homework? You'll try this. Please tell me, Mamta.
Yes, sir. Yes, sir. I'll do it.
Okay, ma. Okay, do this. Two questions. Just a second. I'll go for taxation. I'll wind up this chapter within 5 minutes. You do this question. I'm waiting.
Okay.
If you haven't doubts, you can ask me.
Yes, sir.
So there's nothing like in this rice. I am explaining this one. Rice is considering a project which cost 5,000 now. Annual benefits for 4 years would be 2,500 a year. Okay. So today you are investing 5,000, and what you are getting every year, a fixed income of 2,500. Correct? And
Yes,
there
sir.
is a savings of 500 in year one. This is rising by 5% every year. So 500, there is a rising, your savings are rising every year. So fixed income and savings you have, and there is also some running cost, 1,000 and 10%
1,000.
increment every year. So now from this fixed income plus savings minus running cost, you get net cash flow, correct?
Yes, sir.
And you have to discount at 16%, and the inflation is going on at 7.5%. So you discounted at 16%. You got this NPV. That means if you are going for long projects, it is better for you to go with nominal rate of return, correct?
Yes, sir.
Now go for this second question. Then we will discuss these expectations of inflation and allowing for taxation. Now, please go for this question. I'll be back in 2 minutes.
Okay, sir. I got it, sir.
Hello. Yeah, Mamta, are you doing?
Yes, sir. I got it, sir. 16.3%.
Okay, okay, okay. Just a second.
Yes.
शिवा को मैसेज तो पे फोन पे करो ना शिवा को ये करो इसको काटने के बाद करो कॉल कटने के बाद करो इसको ठीक है बात बात करके बोलो मीटिंग में है मैं कर दे दिया आपको कॉल पैसे बोल के बोलो नाउ मिस्टर गेबल हैज रिसीव्ड बोलो जी कम जरा दूंगा उसको हाँ नहीं नहीं नाउ सो Mr. Gable has just received a dividend of 1,000 on his outstanding on his shareholding in Gone with the Mid Mills. So he received a dividend. Fine.
Yes, sir.
So market value of shares is this X dividend. That means dividend has been paid. They're asking you nominal cost of equity capital. If dividends are expected to rise because of the inflation by 10 years, so they are expecting dividends to rise because of inflation by how much? 10% in years 1 to 3 before leveling off at this year 3 amount. So nominal cost of equity capital is IRR of the following cash flows. Why?
Mm.
Because that is the rate at which your NPV will be exactly equal to zero, correct?
Yes, sir.
That is the break even. That, like nominal cost of minimum what you want. Minimum is nothing but
Break even.
break even. Okay, just a second. Just a second, Manoj. So if the inflation rate is expected to change, the calculation of nominal cost of capital will be more complicated. So they have given the example for that. They are saying the question is all right. Okay, if dividends are expected to rise because of inflation by 10%, so whatever dividend the company is giving is this, but that is going to rise because of inflation. Got it? So, hello.
Yes, sir.
So things are not fixed here. They are going to change. So nominal cost of capital becomes slightly complicated, it seems.
Yeah.
Yeah. Just. So now the nominal cost is nothing but what minimum you require. The minimum is nothing but every investor would at least require the break even. Correct or wrong?
Yes, sir. Correct.
Hello.
Hello, sir.
Every investor would require minimum what actually?
Break even point, sir.
So that break even is nothing but what?
NP IRR.
Yes. So how will you do this? So the cost of capital is given to you. How much? Did they give
10.
anything? No. But
No.
they said it is going to rise by 10%.
Yes, sir.
So market value of the dividends. Okay,
10%.
they are okay. So these guys are doing with a trial and error method. They are taking two rates and trying to find out the NPV of this, sorry,
Yes.
IRR of this particular problem. So 8,000, then it is increasing by 10%, and this is what expected to rise before leveling off at this year 3 amount.
Yes.
That means here it is perpetual. That means it is going to be the same. That is what they are saying. It is expected to rise by 10% in first, second, and third year before leveling off this at this year
Correct.
3 amount. That means it is like leveled off. Again, it will not grow. It is going to be the same. Okay.
Yes.
So from third year they are saying perpetuity. Correct. So
Yes,
at
sir.
15%, at 20%, this is randomly you can take. This is trial and error method. You can take
Yes.
you can take anything to find out your IRR. You got this. So how did you take the present value factor for this year? So
15
factor 1 to infinite. From 1 to infinite, whatever it is, from that you removed factors 1 to 2.
to 2.
You want 3 to infinite, na?
Yes, sir.
So from 1 to infinite, you removed 1 to 2. So then again, it will start from 3 to infinite, correct?
Yes, sir.
1 to infinite is the total. From that, 1, 2, 3. 3 to infinite you want. So 1 to infinite, whatever it is, from that you remove this. So you'll get 3 to infinite, correct?
Yes, sir.
So it is like 1 by 0.15. That is at the rate of 15%, your perpetuity will be this. Whatever it comes, minus factors 1 to 2. You have to add this 2. This 0.870 and 0.756. If you add this 2, you will get 1.626. You get this factor. Okay. And for 20%, again 1 by 0.20. This is perpetuity. 1 by R is the
R.
perpetuity factor. Yeah. So
Yes.
from that you have to remove these two addition. So
Okay.
you get this perpetuity factor. Again you
Okay.
get the IRA.
Okay, sir.
See, inflation definitely are going to expect general prices will rise in the coming future. So if you go for long-term projects, it is better always to incorporate inflation into your cost of capital. That is better. So now allowing for taxation, see, government gives certain deductions. Deductions is nothing but there are certain expenditures. Okay, so if I take a machinery, I will definitely incur depreciation on that, correct? When you take a
Yes, sir.
machinery, depreciation
Will get it.
definitely is an expenditure on that machinery, correct?
Yes, sir.
This machinery you are using for business use,
Yeah.
so the depreciation on that is a capital cost.
Yes.
That is a capital cost kind of, no, because on asset you are getting depreciation.
Repeat.
This depreciation, the government is giving you some relief. That means it is allowed tax allowable depreciation. That means you can claim deduction on this. What you can do?
Claim deduction on.
Yeah. So what it will do? What is the like benefit of this? It will help you tax. It will help you to reduce your tax liability and help you to save more cash. Correct?
Yes, sir.
Yeah. See, suppose some profits I have 1 lakh, and this
Okay.
depreciation I can claim as deduction 20,000. So now the leftover amount is 80. So I will pay the tax on this 80 instead of 1 lakh, because this depreciation is
Relief
kind of this
tax.
depreciation I'm using as deduction. That means deductions are nothing but these expenses can be reduced from your profits in your tax returns, and this will reduce your tax liability. Why? Because now your tax is on 80,000 rather than on 1 lakh. Correct? Correct or wrong?
Yes, sir.
So how much you are saving from this? Suppose the tax rate is 30%. On this
30.
you would have paid 30,000. On 80,000 you are paying 24,000. So your tax saving is how much? Your cash saving is how much?
60,000.
6,000. Hello?
84. Yes, sir. I'm
So
doing some, sir.
try to understand, 1 lakh was your profit, and
Yeah.
this depreciation you are claiming as deduction. So now your profit
6,000.
is 80,000 taxable profit. So if
Yes.
this depreciation wouldn't have been a deduction, you would have paid tax on 1 lakh at the rate of 30%. How much would have been?
30%. 30.
30,000. Now you are paying tax on 80,000. How much it is?
24,000.
So now, because you are paying less tax, it has reduced your tax liability. This deduction has reduced your tax liability and increased your cash saving, because
Yes,
the
sir.
taxes are paid out of your cash reserves. So now 6,000 is your cash saving, correct?
Yes, sir.
Because of the deduction, because of the tax, because this depreciation is allowed as a deduction in tax computation. So tax allowable depreciation deduction
Yes.
can be claimed on this. So this 6,000 cash saving you can directly calculate 20,000 into the tax rate 6,000. So this is your cash saving. Directly also you can calculate. Got my point?
Yes, sir.
That is on depreciation amount.
Okay.
Either you can do this way, this long procedure, or directly you can take this depreciation amount and find out your deduction. That means find out your cash savings from this.
Okay, sir.
Now tax allowable depreciation. So see, this is your 25% of cost. So your cost is how much? 80,000. 80,000 ka 25% is this. Okay. It is at the rate of, it is diminishing balance basis. So what does it mean by, what do you mean by diminishing balance basis? This depreciation again you have to remove from this. You'll get 60,000. 60,000 ka 25% is 15,000 depreciation.
15,000.
Correct?
Yes, sir.
This is tax allowable.
15.
That means you can claim deduction on this amounts. And these are your reducing balances. 60 minus 15, 45 minus this minus this minus this minus this is this. That means this If you subtract from this, you get this. And on all these four amounts, you can apply the tax rate and get your tax allowable depreciation amount, your cash saving amount. Okay,
Okay, sir.
that much amount will be the amount with which you will be saving your taxes. For example, first year's amount is how much? 20,000.
25.
Tax rate is 30%. So how much you are saving your cash? 6,000.
6,000.
That's it. Can we do this question? Please read this.
Okay, sir.
So now what is happening in this? So it is like this. Company is considering whether or not to purchase an item of machinery costing
40,000.
$40,000 payable immediately. So this you will be using to buy your machine, and it has a life of 4 years, and this is a scrap after its lifetime. Machinery would create some savings to you, and then that we will be seeing while calculating the NPV. Company pays tax 1 year in arrears. That means they pay in arrears next year. Okay, the rate is this, and can claim tax allowable depreciation at 25%, reducing balance basis. Balancing allowance is claimed in the final year. That means this balancing allowance nothing but you will be selling this particular asset at some price, correct?
Yes, sir.
So this
I thought.
depreciations, whatever you are calculating, should match with the final amount. Okay, this, see, your depreciation should match with the final amount, correct? For example, if my asset is of 1 lakh,
Hmm.
so if I am doing straight line method depreciation, every year it is 20,000. So
20.
when I add up
Yes.
this 20, it will match with 1 lakh or not?
Yes, sir.
So if in the final year, if I am selling this at some price, I should see after selling
Same.
that at some price, whatever the value it has, it should, this value I should get. So whatever the difference I get is nothing but the balancing charge, correct or wrong?
Balance. Yes, sir.
Understood, Amma?
Yeah, sir.
So now your 40,000, we will direct, you can do in this way also. 40,000,
25%.
you can do the depreciation at 25%. So that will
Yes.
be 10,000. Then you can remove 10,000 from 40,000, you'll get 30,000. On 30,000, again, you can take 25%, you get 7,500. See, what they have done is different. 40,000 into
Into
25% is 10,000. So that
um,
10,000, if you remove from 40, you'll get 30 again. So
yes.
30, 25% is 7,500. Again, remove 7,500 from 30,000, you'll get something. Again, you should take 25% on that. You'll get these values, correct?
Yes, sir.
You are selling some the machine after this, after 4 years, you are selling at this. So it is now the machine is this much for you till 4 years. So it is
Till 40.
creating a balancing charge of 11,875,
10,000.
correct?
Yes, sir.
Now you will, now that is also your depreciation. Okay, then only it will balance with 35,000, correct?
Yes, sir.
So now this, on this you can claim the tax allowable depreciation. That means you can find out your cash savings. So on this you apply your 30% rate, same
30%.
30%, 30%, you get your tax allowable depreciation. That means you claim deduction for this depreciation expenditure, you claim deductions, and this is your tax benefits. You are saving this on, these are your cash savings. Okay, and this one. Now let us put all this in our NPV format and calculate our NPV.
Okay.
And there is also some savings you have.
14,000.
Extra tax payments on, yeah, on this you need to pay taxes. This is your benefit. So the tax you're paying is 4200. Saving, na?
Yes, sir.
So now your machine cost is 40,000. This is your cash outlay in this at the inception. You are getting some cost savings. They said you in the question itself.
14,000, yes.
So yeah, cost savings from the next year, from the at the year end, first year, second year, and third year and fourth year end. Okay, and in the fourth year you are selling your machinery also 5,000 at 5,000. That also you are going to receive. Correct or wrong?
Correct, sir.
That is from the machinery's perspective. And then you are paying taxes in arrears every year. Correct? And you pay taxes on your savings. Am I right? This benefit.
Yes, sir.
What is the tax you're paying? 4,200 in
12,000.
arrears. And then you got some like benefits, tax benefits. That also you need to show.
Right.
Okay? For tax allowable depreciation. And that
Uh,
too on arrears. You paid taxes. You paid first year's tax in second year, and then only you got the benefit in the second year. Correct?
Yes, sir.
Correct or wrong? Correct. Yes.
Correct, sir.
Now you just adjust all these values wherever there's a bracket, subtract wherever there's no bracket, add up, and then apply the discount factor at the 8%. You get this cash flows. Subtract from 40, you get a negative NPV. This project is not a good project.
Okay.
Just a second, just a second. No. See, 12,000, 10,970. This. Okay, this is final year's cash inflow. Sorry. So now when from 40,000, it is 12. 12 plus 10 is 22. 22 plus 9,5 happens to be 31,5. 31,5 plus 12 is 43. 43 minus 43, 44 something. Minus 40 is, yeah, we are getting a positive NPV. This is a good project. You
Okay.
understood how to do this?
So last step I was confused about it, sir.
Nothing but this. What is your cash outflow? 40,000. Add all
40,000.
this 1, 2, 3,
Plus.
4 and these figures. You'll get 45,187.
Okay.
45,187 minus 40,000 is 5,187. Positive NPV, correct?
Yes, sir.
It's a
Yeah.
good project. So all this calculation is to find out the tax allowable depreciation thing. Then you have to put in the format of NPV. Will you do the next sum as homework?
Yes, sir.
Are you sure?
Yes, sir.
This is
20%.
your NPV layout. From sales, receipts or revenue, whatever you generate, you remove all the cost. See, this can also be a format. Why we are removing, why are we doing this? We want cash flows. So from sale receipt, if you remove costs, you get sales less costs, correct?
Yes, sir.
So now
Tax.
again, taxation on profits. Suppose you like there is some like profits or savings you have, like we saw here, 14,000. So on that you need to pay taxes. They will give some data regarding that. So there is an outflow. Then you have a you have a capital expenditure, whereby you will be definitely investing something to buy some machinery and all. Then working capital. Working capital is expected to be invested in the year one. That is during the starting of the project. And then you also expect this working capital to recover at the end. That's the reason why it's an outflow here.
Okay.
And again here it's like an inflow.
Inflow.
Why it's an inflow? Because we expect the working capital to recover at the
Correct.
end of the project. Every question you have to do this.
Okay.
Then if there is a machinery which you have purchased, definitely this machinery will depreciate. Am I right?
Yes, sir.
On that you can claim tax benefits on
Tax.
depreciation. That means tax savings
Yeah.
because of tax allowable depreciation. That you can write. Then you can get all the final cash flows. You can discount them with the discount factor and find out your NPV.
Correct.
Okay,
Yes, sir.
done. So Mamta, this chapter is done. We will do the next chapter tomorrow. Project appraisal and risk. Okay. So now as on today, 1, 2,
Working.
3, 4, 5, 6, 7, 8, 9. Now if this two, if we do this chapter, is this complete unit is done,
Yes.
101% 20 marks question you can get. Then we'll start with this one, source of finance. Okay.
Yes, sir.
Okay, okay, Manta. Thank you. See you tomorrow.
Thank you.
Yeah.